Canadian mortgages, your payments are increasing, interest rates are going up because of renewals, and delinquencies are up as well. All this and more with a good friend and mortgage broker, Mr. Dion Beg. Here we are, my friends, back on the show with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
Hey, Gary. I'm great, man. How you doing?
I'm doing excellent. I cannot believe we are over 6 months into this year of 2024, Dion.
We're into it, man. Yes, it's summertime around the corner. It's been a fast year. Actually, I was surprised just recently at how fast this year has gone. There's so much that's happened, I think, maybe. And when a lot happens, I think time passes fast.
Yeah. And we had our first, interest rate reduction last week or so, or 2 weeks ago now, and perhaps more are on the horizon. But today's call, Dion, is not so much about what we're looking forward to, but perhaps how to protect ourselves in the form of, we're paying more for everything from, groceries to your utility bills. And we're going to talk a little bit about some of the increased defaults and perhaps how do you protect yourself, from renewals and things like that, Dion. So let's get into it, my man.
For sure. I guess before we start with these articles that I know we've prepared, maybe we should just share about the volume of transactions that have happened over the years. And that'll sort of help us sort of understand what's about to happen. So again, before we started recording, I was asking you, what are the average transactions? The easiest real estate board to measure is the Toronto Real Estate Board, right? Or Toronto Regional Real Estate Board.
Oh, there you go.
Correction. But yeah, why don't you share with the listeners like the regular transaction volume and what happened in 2020, 21?
Yeah. So that we only need to think back a few years from now and how crazy, and on one hand, the number of sales and people looking to move and upsize and right size or get a new location. And we hit an all-time record of just over 120,000 transactions. That is a lot of movement. Of course, that does not include new builds. So there's a lot of transactions that year, and we won't see that this year. We will be a far cry from that. And to put it into perspective, 2023, right? We went from 120,000 back in 2021. 2 years later, we hit 64,000. So half of those transactions. A good balanced market, Dion, where everyone's pretty happy, buyers and sellers, and even local governments and municipalities, is about that 85 to 90,000 transactions. That's where everything's just moving along. There's no crazy run-ups or prices, and everyone's just kind of happy there,
Yeah. And what are we on track for this year, Gary?
We started off with a little surge. The spring market has not been the spring market that a lot of pundits, and sellers and buyers thought it would be. And we will definitely have more than 64,000. At the beginning of the year was probably about 74 or 75,000. We have some work to do to get there, to be honest with you, in the last
Are we
couple of
halfway there?
quarters.
Are we at about 30,000 or so?
I'd have to. That's a good question, and let's circle back to that at the end of June, and to get that number. I'm really curious to see where we are. I know we've got some work to do, just based on the level of where a lot of my colleagues are at as well.
Sure. Okay. So to pick up what you mentioned there, so average, let's call it 85,000 transactions on average on the Toronto Real Estate Board. And if we look at 2021, we were up about 120,000. So, huge jump in volume. And that's important to know as it relates to what we're about to talk about, which is what people in our industry are calling this mortgage renewal tidal wave or mortgage renewal tsunami. You'll see these headlines as the months progress here. And that is because in the years 2020 and 2021, more people took mortgages in those 2 years than in any other period of time. And traditionally, people take 5-year terms. And those 5-year terms are now coming to maturity in the years 2025 and 2026. So these 2 years ahead of us are when we're going to see a truckload of renewals. On top of that, we had people who did renew 2 or 3 years ago into higher interest rates, in particular in the last year or two, and they all took shorter terms. So they took 2-year terms or 3-year terms. And that means that, again, it all compresses into the years 2025 and 2026. So we're going to have more Canadians renewing in these next 2 years than I think in any other period of time, right? Coinciding with higher interest rates, right? So let's see how this is translated into some of these institutions, Gary. And you might want to pull up that first article there, where and they're talking here about RBC. So yeah, I'll give you a bit of background. This is from one of the industry magazines out there called Canadian Mortgage Trends. A lot of people in our industry refer to this, and they have good links to original source articles and stats. But for a summary for today, we'll jump into this one. So RBC is talking about a rise in mortgage delinquencies and pockets of stress. So they're seeing it, in certain areas, is what they're saying. And I don't think this is a surprise to anybody, understanding where rates have been and the pain that people are feeling, not just on their mortgage payment, but on everything from groceries to gas to electricity and all sorts of things. So if we just slide down there, Gary, let's see how badly is RBC doing. For starters, let's stop there. And I don't think it's a surprise for anybody that, guess what? RBC made $4 billion, up in this quarter, up 11% from last year. Okay. Wow. So as much as the general economy is hurting, the people on the street are hurting, is it a surprise that financial institutions aren't hurting? I don't think so. They made an extra $400 million year over year in the face of all this. And I was sort of trying to hypothesize, Gary, as to why this is the case. And some of it might have to do with mortgage volume. But I think also, and what we've been seeing, and I'm sure that you've been hearing about it in the streets, where people have had to start to lean on other credit facilities, right? And, a mortgage interest rate might be at 6%. But do you know what the average credit card interest rate is, Gary?
Is it higher than the 19%? Are we going there?
Yeah. So, I've recently spoken to clients who have multiple credit cards in the 23, 24, 25% interest rate range. And when I asked them, why did you let it get this far with your credit cards? And like, well, Dion, we knew that we wouldn't qualify for a mortgage. So we just had to take the easiest to qualify for facility. And I know this kind of sounds strange, but a lot of you people listening would already know it's actually much easier to qualify for a credit card than it is for a mortgage. It's actually easier to qualify for a credit card than it is to qualify for a personal line of credit as well. And the spread on that is it's probably 12% on a personal line versus 22% on a credit card. And so, again, my guess is that a bunch of this extra revenue that's coming into not just RBC, but other lenders as well, is potentially because they're lending on credit facilities which earn the bank a much higher rate of interest. Okay? So that's one thing to recognize. And if you're out there and you feel like, oh, geez, I've been using my credit cards just because it's sort of the last thing I can right now to keep my head above water, you are not alone, right? Many, many people are in that boat. And I'll just give you a little bit of history. During COVID, so many people came into extra cash because they weren't traveling, and they were getting government support, which many people just banked. And when interest rates went up, they actually used that money that was effectively their savings to get them through some tough times. But a lot of that has now come to an end. That money's run out. And so now people are leaning back on these other credit facilities where, they're running up a little bit higher. So that's what I'm seeing anecdotally with the applications that we're seeing. And I'm sure this is a much bigger thing across society right now.
Yeah. Interesting. Okay. Moving down, there's some other interesting info on this article, Dion, should we talk about the amortization?
Yeah, exactly. So this is, if we just jump down to that bottom line there, and this bottom line talks about what percentage of RBC's portfolio of mortgages currently has an amortization longer than 35 years, okay? So first, let me ask you this, Gary. If you or I walked into RBC today and asked for a brand new mortgage, do you know what the longest amortization they'd be able to offer us is?
Are they looking at 25 or can we get 30s? I'm actually, this is a good question. Yeah,
so we can get 30 as long as it's a conventional mortgage, which is not insured, okay? So 30 would be the number that you would expect, that would be the highest that we would be offered, okay? So the question is, why the heck does this have a line here showing that they've got a bunch of mortgages that are 30 plus years, 35 years plus, right? And the reason for that, guys, is that because during the last couple of years, a lot of people at RBC and many other institutions hit what they call their trigger rate mortgage. Okay, actually, sorry, let me take a step back. RBC, as well as many other major banks, offer what they call a static payment variable rate mortgage. So the rate can change, but your monthly payment doesn't change. What happens is the portion of your monthly payment that goes to pay down your principal is smaller. And so every month you're making this payment as interest rates rose, your mortgage was getting paid down at a much slower pace. So if you signed up for a 30-year amortization, and then this started to happen in the mixture of your mortgage payment, then it means that every month you stretched out your amortization. So this happened month after month for many, many months during the last couple of years as people hit their upper limits. So we've got a lot of people who are now in 35, 40, 50, 60-year mortgages, okay? So that's an interesting highlight right now. What we can see is a positive trend here, Gary, where a couple of quarters ago, they were at 25, at the very bottom line there, they were at 25% of their portfolio was over 35 years. But people have, I think at maturity, they've now been pulled back to their standard amortizations. So it's gone down from 25% of their portfolio to now just 19% of their portfolio in Q2 of this year. So what that means is people are effectively coming back to their original amortizations. And this is, by the way, the plan for the government, guys, where they've told institutions that at maturity, when people come up for their 5-year renewal, that if they're in a 45-year mortgage amortization, they must be put back on their 30 or 25, whatever it was that they signed up for. So that's why you're seeing this sort of shrink a little bit. Again, for those listening who happen to be in these scenarios where you're managing payments only because your lender has given you a little bit of a break on these amortizations, meaning your monthly payment's lower, you need to prepare. You need to prepare for the idea that when you go to renew your mortgages up for maturity, you will be forced to compress that time frame, meaning your payments are going to jump. So please be prepared for that. And if you're not prepared for that, you should start talking to your institution or mortgage brokers, such as myself, to make a plan for how to deal with that.
Yeah. Okay. And picking back on that comment, Dion, there's a lot of people perhaps are thinking, my mortgage is not up for renewal until next summer or things like that. You don't want to be having this conversation with Dion a month before your mortgage is up for renewal. And heaven forbid, well, I shouldn't say that. There are people that are choosing to sell based on perhaps the increase of their mortgage. Don't wait a couple of months before this conversation, because in some cases it could take 3-4 months to have your home sold. And you want to be well in preparation as opposed to kind of up against the wall, right?
Yeah, most definitely. And again, it's one of those things where, unfortunately, I do end up helping a bunch of people who left it too late. What that does, it diminishes choices. They become that distressed seller that they never wanted to be, right? So, yeah, in order to avoid that type of stress and becoming the distressed seller, you have to plan early.
Yeah. Good stuff. I know there's one other chart here in this article you wanted to highlight, and let's kind of digest this a little bit.
Yep. So that top line there talks about residential mortgage portfolio at RBC growing. And as you can see, it's grown in a couple of quarters from about 350 billion to now 400 billion. Because some of that might have to do with the fact that RBC did acquire HSBC. I'm not sure if it's reflected in this chart here, but just so you all know that has also happened in the last couple of months. Then let's jump down to the middle of the chart here, Gary, where it's got that 90 days past due. Mm-hmm. So guys, this is the measure of what they call mortgage delinquency rate. So if you miss your mortgage payment or you're behind by 3 months, that's when it gets registered here. And as you can see, a couple of quarters ago, we were at 12% with RBC, and now they're at 0.12%. And now it's at 2%. Okay, so it's still a very small number in general, but it's still a significant uplift from where they were just a couple of months ago, right? And I just want to point out, guys, that this, in any interest rate environment, there are always going to be delinquencies. People get separated. They have medical issues, which means they can't make payment. People unfortunately pass away and the house is left to a spouse who doesn't have income. So mortgage delinquencies are common. The question is, are we exceptionally higher than standard? We aren't yet, but the trend is such that, we could probably expect it to increase in the next couple of months. And that's reflected by the next line we're going to look at here, Gary, which is the provisions for credit losses. Now, what this is, guys, at the second last line, it shows that a couple of quarters ago, RBC had made provisions of $600 million for potential losses in their credit portfolio, right? So people not making good on their payments and then potential losses suffered by the bank for that. 600 million just 2 quarters ago, and now we're up at 920 million in credit loss provisions. So what does this mean? Again, this means that this institution and others are expecting more credit defaults in the months ahead. And again, it's all reflected there. And again, this is because of the things we discussed earlier, Gary, with the number of mortgages that were taken out over the last couple of years that all come to renew in 25, 26. So they're preparing for this renewal tsunami by putting aside these provisions for credit losses.
They are.
So,
yeah. And I don't want to correct you, but I know as people are reading this, and I know this is what you're intended to mention, we're looking at Q2 2023 versus 2024. But if you look at Q1, that trend is still the increase in following to Dion's narrative there, or really the bank's narrative of what we're explaining. But it's important to educate yourselves on what's going on around you. And if this is what the banks are seeing, well, quite frankly, this is probably what your local subdivisions and neighborhoods are perhaps experiencing as well, right?
Yeah, most definitely. And I mean, look, if the banks who have so much data on the economy and on payments, if they're expecting this, it's going to happen, right? And so the question is, if you feel like you're going to be in that category of people who are going to be impacted here, then you need to make a move, right? You need to start getting in front of this before it really, really hurts you. Hurts your credit rating, hurts, you don't want to miss a mortgage payment, guys. Let me tell you that thing is going to be reflected on your credit bureau, and it's not something that's going to make your life easier if you ever want to get a mortgage in the future. So if you're coming into some tough times, if you've used up all of your, pandemic savings and you're approaching the limits on your credit cards, like now is the time. It's not going to get easier. And, I'll say this from a psychological perspective, Gary. I speak to a lot of people who, when I say to them, what took you so long to actually pick up the phone and call us? And it was just because I call it kind of like the ostrich syndrome. They stick their head in the sand and they're like, I don't want to deal with this. I'm not even going to look at my credit card statement. And then they get a call from a collections agency or something. And that's the trigger that they needed to say, okay, you know what? I got to pull my head out of the sand and I got to do something about this. So just don't be the ostrich. Like, get in front of it. Take action while you can.
Yeah. Good stuff. Okay, let's move on. OFC doubles down, keeping stress tests for uninsured mortgage switches. Okay, first of all, what does this mean, Dion?
Okay, so OSFI is basically the governing body for the financial regulations inside for financial institutions. Okay, financial institutions. Their job is to maintain the health of the Canadian financial infrastructure. Okay, so the thing is that their mandate is not to help the Canadian consumer directly. It's to maintain the strength and health of the economic system through the banking systems. So there's been a lot of discussion over the last couple of years in particular about the idea that when we go to renew our mortgage, if we want to move our mortgage from bank one to bank two, we are still currently exposed to the stress test, okay, which makes it a little bit more difficult to qualify. And what it means is, in many cases, because of where rates are, people are stuck with the lender that they're with, and they can't move to lender number two, even though lender number two has a better rate, better product. Okay, so there's been a lot of lobbying to OSFI to say, hey, why don't we reduce the stress test and make it the contract rate, test the deal at the contract rate from switching from bank one to bank two, because these people have obviously proven that they can make their payments. Why should they be exposed to this higher number? Basically, their office has said, no, we're not going to change anything here. It's going to remain the same. The weird thing is that when you are changing from bank one to bank two and you have an insured mortgage, that is, you maybe borrowed more than 20%, borrowed more than 80%, you put down only 5 or 10% down payment on your purchase, you can move from bank one to bank two without exposure to the stress test. The technical reasoning why OSFI allows this is because the risk remains with the same party. That is, it's with CMHC, and you're going to bank number two, but the mortgage is still insured with CMHC. Therefore, there's no change in the counterparty who's underwriting that risk. So that's why they're saying it's okay for this to be the case on insured mortgages, but not on uninsured mortgages, conventional mortgages. That all said, it's still unfair, but they're not changing their position. All of this to say, it's still going to snowball and impact with this tsunami as well, Gary, because people who could potentially get a better rate at a different lender are going to be stuck with their current lender at the current rate or whatever rate their lender's happy to give them. And that's going to maybe impact their ability to maintain their payments, right? So another issue that could compound this whole renewal tsunami that they're talking about.
Yeah, exactly. And Dion, remind me, is there something we want to dig deeper onto this article, or should we move on to the next one?
We can move on to the next one. Yep.
Yeah, excellent. Good stuff. Okay. Next one from the same website, my friends. Borrowers leaving money on the table by not negotiating their mortgage renewal rates. Dion, we're always coaching and telling our clients, have this conversation. However, they're starting to get a little bit of a pushback here, aren't they?
Yeah. So the thing is, you and I mean, people are cutting costs wherever they can. You've probably seen people stop some of their subscriptions to some of their online services. They're maybe changing where they're shopping for their groceries. Maybe they're driving to the next gas station to save a couple of cents. Like, this is all happening right now. We know this is happening. Now, the largest expense that almost everybody has is the cost of shelter, which in this case relates to mortgages. And you would expect that people would be really pushing for the lowest interest rates that they possibly could get, especially at time of renewal. Now, the survey came out to say that people are doing this less than they have traditionally done, say, in the last couple of years. And there's a bit of speculation as to why. So, I mean, you would think, right, most people trying to save money everywhere, would try and save money on their mortgage. The sense here is that the people who are up for renewal on their mortgage, they know that they can't change lenders. And so they're not pushing back on their current lender as hard as they would have maybe in the past, because they are maybe somewhat fearful that if they push back, that the lender is going to say, well, show us your income documents and let's see if we can qualify you for this better potential rate. And they know that they're not going to be able to put forward income documents that are going to help them with that. Now, I just want everybody to know that at time of renewal, traditionally there's no obligation to confirm income status, right? So a simple example, guys, let's say a young couple buys a property. They get a 5-year mortgage. In year number 2, they have a baby, and the wife decides to stay at home and become a stay-at-home mother. So at time of renewal, they've lost her income, okay? That bank's not going to kick those people out on the street as long as they've never missed a mortgage payment, right? But if that couple needed to requalify for that very first mortgage that they got, the same mortgage, they may not qualify, right? But we're not retesting income at time of renewal or maturity. So I just want everybody to know that most of your institutions won't be testing you for income, so you should push back a little. And in some cases, in many cases, in fact, we have been able to move people from lender number 1 to lender number 2, just because we might be able to approach income a little differently with a different lender, right? So a lot of self-employed people think they're stuck. There's a lot of self-employed programs out there that will allow you to recognize, for example, your retained earnings as income. So a lot of people don't know that. Some people have significant net worth separate to their income, and we can actually use that net worth to help people qualify with a different institution as well. So just know that it's not just what's on your T4 or on your notice of assessment that can help you qualify for mortgages, but other factors as well. And sometimes when you first qualified for your mortgage, you didn't have those retained earnings or net worth which you now have, which will allow you to move. So just know that there's lots of reasons why you should reach out to mortgage professionals at the time of renewal and not just accept what your institution is willing to offer you now.
Yeah, and I know we've talked about this in many other videos. When that mortgage renewal, or you have one coming up, typically your current lender starts sending that out at about, what do you say, 3 months in advance, something around that line?
3 to 6 months in most cases. Yep.
Yeah. And maybe when you've received your first mortgage renewal letter, that's when you sort of start doing your investigation and your research. Reach out to someone like Dion, right?
Yeah, that's correct. And I mean, I'll say to the guys, if you have a renewal coming up, please don't just accept what you've been offered. Please reach out to ourselves or a mortgage broker that you trust and double check that you are being offered best rate, because like with most things, they don't offer best anything to existing customers. It's almost always, the sweetheart deal is given to brand new customers, but once you are an existing customer, they may not get or offer you that same rate. Our job is to make sure that you get the best possible for yourself.
Absolutely. So we covered a lot today, my friend. And it might seem like it's the doom and gloom, but however, what Dean and I are working hard to do is, peel that onion away and share, the facts and then how to navigate through those murky waters, perhaps that you someone that's going through this right now. And there is a light at the end of the tunnel. We do know, and the Bank of Canada has come out and said this, that they expect to drop the rates once or twice, maybe even a little bit more by the end of the year. And we know that rates will be coming down even from where they are now, right?
Well, in that same article earlier, the RBC is still predicting a 1% rate drop by the end of the year, meaning 3 more rate drops. I think that's a little ambitious, personally. And they're backing that up with another expected 1% drop by the end of next year, meaning a 2% drop from the start of this year to the end of next year, which would be amazing to see. I'm going to be a little bit more conservative in my estimations and say that maybe we'll get 1 or 2 more this year and probably not a full percent next year. But again, let's see what happens in the economy. I mean, we've seen the employment data come out quite negative. The GDP per capita info come out again, very, very subdued. And we are in recession, 7 consecutive quarters based on GDP per capita. So look, hopefully I am pleasantly surprised by, more and more rate drops.
Yeah, let's prove them wrong, Bank of Canada. Let's prove them wrong. All right, my friends. Dion, remind us how to get a hold of you.
Yeah, so guys, kangamortgage.ca or Instagram at the Dion Beg.
There you have it. The Dion Beg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now. All right.